2001, I found myself briefly sort of unemployed, underemployed, about a year or so, and I applied for what's known as a hardship forbearance through my lender, by which I would be able to withhold payments for 6 months or a year while I got on my feet financially. Well, unfortunately, instead of granting my forbearance, my lender, who happened to be Sallie Mae, put my loan into default. And so very quickly, within a little over a year, my loans had ballooned to $80,000 with penalties and fees. And by 2005, I was being billed for well over $100,000. And this is despite my best efforts through every step in the process to negotiate what I consider to be a fair and reasonable payment plan for the debt. And I mean, this really caused me to wonder why I had such little power as compared to other forms of consumer debt. And so in researching the topic, I found out that, nearly every standard consumer protection that we take for granted with every other type of loan in the nation is simply non-existent for student loans. They used to exist, but thanks to the lobbying influence of Sallie Mae, Citibank, the Consumer Bankers Association, and others.
Alan, can you explain what Sallie Mae is?
Yeah, a lot of people are wrongly in the understanding that Sallie Mae is a part of the federal government. They are not. They started in 1972 as a government-sponsored entity. That is true. However, Sallie Mae privatized starting in 1995, and today they are a completely for-profit entity with no formal ties to the government.
And so explain who profits. Continue with the story.
Yes, well, in the absence of bankruptcy protections, for example, statutes of limitations, truth in lending requirements, refinancing rights, fair debt collection practices in many cases, and also state usury laws, the industry finds that it can be far more profitable when a loan defaults rather than a loan remaining in good stead. And this is also due to congressionally mandated collection powers that, in the words of Harvard professor Elizabeth Warren, would make a mobster envious. So and I think this was mentioned earlier in the trailer for the documentary, they can garnish wage, tax return, Social Security, disability income, all without a court order. Not only that, but they can suspend professional licenses. They can have, well, this causes security clearances to be denied. And this is in addition to all the sort of pain that a delinquent borrower would face with any other type of debt. So under the current system, lenders like Sallie Mae make a lot of money if you can pay your loan and everything goes smoothly. However, they can make a lot more money, particularly the large lenders like Sallie Mae, Nelnet, and others, when a student defaults on his or her loan. And the reason is that they sort of get a second bite of the apple. So when a loan defaults, the lenders are paid nearly full book value, principal and interest. But upon default, the loan is literally exploded with just massive penalties and fees. And so lenders like Sallie Mae, who also conveniently own collection companies, can come back for a second bite of a much larger apple.
Does Sallie Mae function like Fannie Mae and Freddie Mac? Are they basically buying up loans that others originally make, or do they originate their own loans? How does that work?
Yeah, they're very similar, and Sallie Mae began as simply a warehouse of loans, much like Fannie Mae and Freddie Mac. However, over time, they sort of took over the industry, both vertically and horizontally, frankly, to where they were not only sort of repurchasing loans, but also originating loans, consolidating loans, and most recently, Sallie Mae and others have begun to take advantage of what's known as the private student loan market. Private student loans are not guaranteed by the federal government and typically are used as a bridge between what the universities are charging now and what the federal loan limits allow. These loans typically have very high interest on a par with credit cards. But again, not only are federally guaranteed student loans astonishingly absent of bankruptcy protections, but in 2005, the industry convinced Congress, how I don't know, to remove bankruptcy protections from private loans. So these private loans are very, very dangerous, and we have with the student loan industry.
Reverend Jackson,
Congress,
talk more about the bankruptcy issue.
Well, the students, really are seduced into the loans. I was talking to students from Northwestern last week, and they're just kind of signing off, assuming when they get out of law school, they can kind of pay it back. But now many of those jobs don't exist, so they can't pay it back, and they marry each other, which doubles the burden and the compounded interest. And so that's a big piece of this. And then, of course, if you don't pay back, you can use bankruptcy laws to get out of your foreclosed house, but not out of the federal loan. So there's more stringent standards on students who are trying to pursue an education, even than those who have faced the home foreclosure crisis. And students I have found accept this as kind of the price I pay for pursuing an education. Not long ago, you could be a first-generation student in college, you marry, you mate, combine a bank account and buy a home, first generation. Now you marry into debt. You're worse off by getting an education than by not getting one. It makes more sense in this sense to get an associate degree at a community college and have a trade, someone lay in line for Verizon, than it does to go to a four-year university. And so our basic appeal is let students have the same deal banks get. And that alone would be a massive cut. Cut the middle person out and let students have direct access to the money and have some civilized. And for example, if you become a doctor and you have a big loan, if when you graduate, you serve in some indigent community, you can work it off in that way. If you become a lawyer, because now to go to law school or med school is just prohibitive. You come out with $250,000 worth of debt.
Reverend Jackson, I'd like to ask about the responsibility of the colleges and schools which these students are attending to counsel them on this whole loan process. Because my understanding is in interviews with some college students that basically they're encouraged to take out as much money, sometimes even more than just a tuition for the school. They're basically encouraged to take out huge loans. And what is the responsibility of the colleges?
Part of the scandal that Andrew Cuomo unveiled was this kind of university manipulation with the banks, for example. That has to be dealt with as well. But it's now time for a comprehensive look at this. The president asked for students to pursue an education, come out and do community service. You cannot afford to do community service unless you tie in working off the loan with community service, for example. But I think most Americans have no idea. I'm looking at teachers who are paying off student